And so in the 90s, producing a story around the idea that we were managing high yield out of a predominantly equity shop at that time was hard. It was difficult. In most cases, they said, we don't get it. Why would you not be at a bond fund or bond firm in order to bring a high yield fund? Well, now, 24 years later, pretty much everyone is aligned that the company's fundamentals, the underlying benchmarks that you would measure that company's success, whether it be earnings growth, cash flow growth, debt, the leverage reduction or increases, those same philosophies apply to the stock of the company and the debt of that same company, especially when it's below investment grade. They are very correlated. High yield market is much more correlated with the equity market than it is with the bond market. So when we grew the story, when we were thinking about how to create a high yield product that would be differentiated and meaningful for clients, we started with the fact of equity analysis is critical. So a lot of those same drivers, is that company going to meet or exceed expectations over time? Does it have the financial foundation to meet those needs? Those are critical first line opportunities that we are looking for. So the special feelings I hold is that we created it from nothing. Having those equity teams right embedded within our own group and around the entire investment floor in San Diego is critical. Having those shared meetings with company management teams when they come through, having shared meetings with sell-side analysts when they come through, and looking at that entire capital structure. Clearly, if our equity teams believe it's a good idea, the high yield should be an excellent idea, because if the stock price is going higher, they are exceeding expectations over time. And that's the type of areas that we want to focus in high yield. In many cases, it's growth companies. You would consider us, if you're thinking about us in the context of an equity manager that is growth or value, we would be much more on the growth side. We want to see improvement over time, rather than be a distressed buyer that hopes that the company will work it out later. That's a different style of investing. Distressed credit is very different, where you would incur more defaults. Maybe there's more upside potential, but we want to protect on the downside, make sure that's not a core element of a client experience. Participate in the upside, protect on the downside. It starts with the identification of the right company that's positioned well competitively, has maybe a new management style, or they've had a merger, or there's been activity in that area. They're in an industry that's dynamically changing. There's a better pricing performance, there's more customer demand. We've identified these things and we share that as a one-page summary amongst the teams, and we challenge that. And each team member is going to challenge those assumptions. We're also going to talk about the core risks. Every company in the high yield market has some level of risk or it wouldn't be high yield. So we have to go through those as a team and all of the team members getting together. But most importantly, from a rising star standpoint, we have to use that credit model. We have to look at the leverage ratios today and where it will be 12 to 18 months to 24 months from now. Should the company need to borrow significantly, that's going to be a deterrent to that. Are they paying down debt aggressively? That's something that's going to be a positive catalyst for that. Should this be an industry that has heavy capital expenditures? That's going to be a negative impact. Is it a company that's rapidly growing on the revenue line and expanding operating margins? That's going to be a better candidate. So these, as you go through the system of all the companies, those are the ones that are most aligned to be a rising star.
投资一定有风险，基金投资有赚有赔，申购前应详阅公开说明书或投资人须知。